So welcome to this video. In this video, we are going to discuss about financial markets and instruments. So we are going to learn these topics. So we are going to learn about financial intermediaries, financial markets, securitization, international money and capital markets, money market and instruments, and what is risk return trade-off. So these might form a part of your 2 marks. This chapter will not come in section C, so it is going to be only in the section A and B. Section A and B are just 2 marks OTQs, so you have to prepare in terms of understanding the concepts behind it, and you can also browse Google to get some more information about this topic, and you can go for the exam. So this is not a very in-depth topic, so overview of information is more than enough. So we'll start from who is a financial intermediary. So a financial intermediary is an entity that acts as a middleman between two parties in financial transactions. Usually a commercial bank, a insurance, a mutual fund, pension funds, stock exchange, chit funds, all these entities are a financial intermediaries. So what kind of service do these intermediaries offer? They offer a lot of benefits to a average consumer like you and me. For example, they give you a safety. For example, we might invest in a savings bank account, and the bank actually lends it to another person. So we cannot lend to another person who we don't know, but banks can do it. So they offer safety to the investor, liquidity. So whenever you want money, so you can close your savings bank account, or you can make a withdrawal from your savings bank account. So that's a liquidity. So if you are going to lend it to someone else, whenever you ask money, you can't get the money back. So there's a difference between depositing in a savings bank account and lending to someone, and that is like liquidity. And the economies of scale. For example, the person to whom you have given a loan, suddenly they are not able to give you it back, okay, due to some problem, then you are stuck. Your money is stuck with that person. But in a bank, that doesn't happen, because banks actually lend the money which you gave to several hundred people, okay, several thousand people, or even millions of people. So even if some of them don't pay the money back, okay, the bank will give your money from the money which they have collected from other customers, okay, and they will pay you back. So if you are going to deposit in a savings bank uh, if you're going to deposit in a savings bank account with the bank, then it offers you a lot of benefits. It's not only like savings bank account, it can be like in terms of insurance or mutual fund, pension funds, in investing in stock exchanges or in chit funds. In all these kinds of financial intermediaries, they offer these benefits. So this is where we come. We are the household, business firms, or government, or even foreigners. All these people can invest their money directly in the financial market, okay, or they can route their money to the financial intermediary. So financial intermediary, example like bank, gets your money and then invests in with the other people. So you can also directly put your money into the financial markets. For example, you can buy shares directly, you can buy bonds, you can buy debentures. So these are like directly you transact with the financial market. So there are areas in which you can directly transact, and there are areas in which you can go only through the intermediary, okay. So that's the functions of an intermediary is. So what are the various roles that financial intermediaries play? For example, a commercial bank gets the money from the saver and gives it to the borrower. Insurance collects money from a large amount of people as a premium, and if any of them are going to be like affected, then which is like low probability event, they pay from the money that has been collected from other insurance holders. So if 100 people are going to invest rupees 100 for their insurance as a premium, the company has got 100 rupees, but the insurance companies know out of these 100 people, only two people might be involved in an accident, so only like 2 rupees is like gone. Still the insurance companies has 98 rupees which they will hold. So insurance is like spreading the risk. That's what insurance companies do. Or mutual fund as an intermediary. Mutual funds collect money from a lot of people. Then mutual funds invest that money on behalf of the uh, mutual fund holders. And pension funds work in the same manner. The pension, which is like collected from a lot of people over a long period of time, is invested in the stock market. Or there's something like a crowdfunding. Crowdfunding is like a very new model. Crowdfunding is like has with intermediary and without intermediaries, but we'll speak in terms of crowdfunding with an intermediary. So what happens is you can invest, you can give your money as a loan to any person, but in between financial intermediary, a crowdfunding company will be there. So assume that you want to collect money for a project, you can crowdfund the money, you can get the money for your project, and once a project is like successful, you can return the money back to the investors. Okay, so that's how crowdfunding works. So what is the benefit of having a financial intermediary? Convenience of amount and ready source of funds and aggregation. So what happens is like if you're going to invest with the savings bank account, it gives you the convenience. You can have any amount of money you can deposit. So whenever you need, you can also withdraw it, and it's also aggregated. So the bank gives you the promise that you can get the money at any point of the time. It's lower search cost, so you don't need to go and try to find out who is going to give you the highest interest among your friends or among your relatives. You just go to the bank, deposit, and you get the interest. So the search cost is like very reduced. So the cost, such cost refers to the information that is like available, okay, and also the time that you spend in searching for that information. Economies of scale. So banks like mutual funds, banks, insurance, they have a huge large amount of economies of scale. So you don't take much risk when you deposit your savings bank money with a bank. Spreading risk. So if you give a loan to another single person, he might cheat you. But if you give it as a savings bank money, then deposit, then the risk of your money getting lost is like very, very negligible. Maturity transformation. So it works like this. Assume that you go to a bank and you take a 5-year loan. Okay, you take a 5-year loan, but people in the bank would have deposited their money for 6 months. They would have deposited for 1 year, or they might have deposited for 10 years. Okay, so like different types of depositors are there in a bank, but you want a 5-year loan. Okay, so how does banks are able to give you it? Because there are like continuously people who are investing for 6 months with the bank, or there are continuously people are investing for 1 year, or there are like people already who have invested with the bank for 10 years. So the bank is able to give whatever duration of loan you want. If you want a 1-year loan, if you want a 5-year loan, if you want a 10-year loan, whatever you want, they are able to give you, because this is the power of maturity transformation. Risk pooling. So again, risk pooling and spreading risk are the same. So risk pooling refers to you giving money to one single person, he'll cheat, but banks give to millions of people. So even if a few of them cheat, bank is able to withstand that loss. So these are the benefits of financial intermediary. Which of the following is usually seen as benefits of financial intermediation? So which are the benefits? Interest rate fixing. No, they cannot. A financial intermediary cannot fix a interest rate. Interest rate can be fixed only by the central bank. So that is not a benefit. Risk pooling, yes, they offer us risk pooling. Maturity transformation, yes, they offer maturity transformation. So 2 and 3 are right. So the answer should be C. So the answer is C. Interest rate is fixed by the market or by the central bank. So in this slide we'll discuss about financial markets. A financial market is a market in which people trade financial securities, commodities at low transaction cost and at prices that reflect the demand and supply. So financial market is where financial securities and commodities are traded, and the price is actually a reflection of the demand and supply. Okay, so the price is a market driven price. So no one is fixing the price in a financial market. It is a market that fixes the price. Securities include stocks, bonds, commodities include precious metal or agricultural products. So again, we look at the same diagram. So here we have the financial markets. So directly, investors like you and me, we can directly go to the financial market and purchase it. So this is another image which tells you about the financial markets in total. You don't need to you don't need to mug up or memorize this diagram. You just need to understand the various parts of the market. So the financial market is like divided into two parts. One is called as the money market and the other one is called as capital market. Money markets are a very short duration market, and if you take the capital markets, they are like long duration market. So what is a short duration market is any security in the money market is usually sold within a year, and equity and the capital market is something which is any instrument here which is traded is more than a year. Okay, so the difference between the two markets is the time. Here it is within 1 year and here it is more than 1 year. Okay, so that's how it works. So within the money market we have the short term credit market. So unorganized you can leave. Organized we have the call money market, we have the bill market, bank loans, and treasury bills market and commercial bills market. In the long term funds market, again we leave the unorganized. The organized has the stock market. Within the stock market we have government bonds. The bonds also get traded. So government bonds, here it's a corporate issues such as the bond or the equity. So organized market also takes into account the loan market from the banks and non-banking financial intermediaries. So this is about the overview about the market. We'll look in detail about the actual market. So first we'll discuss about the capital markets. It is a market for buying and selling equity and debt instruments. So it is a market where uh, any instrument which has like more than 1 year, they get traded. It channelizes the savings and investment between suppliers of capital such as retail investors and institutional investors and users of capital like business, government and individuals. So capital market connects people who has money and who wants money. It is vital for the functioning of an economy since capital is a critical part for generating economic output. Capital markets include primary market, where the new stock or bond issues are sold to the investors, and secondary capital market, which trade existing securities. So we'll discuss about these two markets in detail, the primary market and the secondary market. So first we'll look at the primary market. See, assume that you are having a company and you want to issue shares. The place at which you go and issue is called as the primary market. So the primary market is not like physically different from the secondary market. So it's not like this is in area 1 or that is in area 2. Both are in the same place, and both of them are like virtually only they are existing. So, but just for our convenience, the market is like divided into two parts. Okay. So assume that you are a CEO of a company, it's your own company, and you want to sell the share. Where will you sell the share? That is the primary market. Okay. A market that issues new securities on an exchange. Companies obtain financing through equity based securities. So you can sell your equity shares here. Primary markets are facilitated by underwriting groups, which consist of investment banks that set the price range for a given security and then oversee its sales directly to the investors. So, if you want to sell a part of your company as equity shares, then you can't do it directly by yourself. You should have people called as underwriters, and you should have people called as investment banks. These people will help you to ensure that you raise the capital. So it is also known as the new issue market. So cash is raised by promoters by selling part of their holdings in the company to others. Such cash is raised for the following purpose. So why do you need money by selling your equity shares? It can be to promote another company. It can be to expand your existing business. You need money to diversify your production or products, to meet the regular working capital requirements, or to pay off a loan that you already have. So whenever you want to raise money from the primary market, you also have to give reasons for raising the money. So we'll see what is the meaning of an IPO. So IPO is once you want to raise money from the capital market to issuing share, that is called as IPO, initial public offer. So you are selling the shares to the public. You are not trying to selling the shares to a few set of people. You are trying to sell it to the public in general. So it's called as initial public offering. So it refers to the offering or flotation. So both has the same meaning. Is when a company issues shares to the public for the first time. So what is the benefit of having an IPO? So we can have a easier access to the capital market, and the prestige, the exposure and public image of the company is much more higher. It helps to attract and retain better management if you are a listed company, and an already established company can use its goodwill to raise money from the market. It also helps the people who buy your share to it also helps to have liquidity for the shareholders. They can now buy the shares. So that is the benefit of having a IPO. So you can raise capital. So now we look at the secondary market. So we have discussed about the primary. Secondary market refers to a market where securities are traded after being initially offered to the public. So once your company has gone for an IPO, they can then the shareholders who have bought in the primary market, they can then trade in the secondary market. Okay, so in the primary market or listed on the stock exchange, majority of the trading is done in the secondary market only. Secondary market comprises of both equity and debt market. So it's not only for equity share, even debenture and the bonds can be traded in secondary market. The secondary market enables participants who hold securities to adjust their holdings in response to their assessment. Okay, so they can buy share, they can sell their shares in the secondary market. So they also sell shares for liquidity needs. So now we will discuss about the money market. The money market is where financial instruments with high liquidity and very short maturity are traded. So very short maturity refers to their instruments within a year. Okay, their lifetime is only within a year, and they are also highly liquid. It means that you don't need to wait for selling your debenture or bond. You can easily sell it quickly and get the money back. So it is used by participants as a means for borrowing and lending. So assume that you have money, you can borrow and lend in the money market in the short term with maturities ranging from overnight to just under a year. So we said it can be the maximum time limit for money market is 1 year, but the minimum time limit is actually one overnight. You can buy the instrument in the evening and you can sell the instrument in the morning. Okay, so the minimum time duration for holding the instrument can even be in hours. Money markets, which provide liquidity for the global financial system and capital market, make up the financial market. uh, Very money intensive, whether it's capital equity market or debt market is. Debt market has a larger size when compared to equity market. The reason is every company wants to get a loan and they have to get a loan at a frequent intervals. So the money market is actually much more active and the larger in size compared to the equity market. So money market and instruments we'll discuss. So these are the various instruments that get traded in the money market. So we'll be like discussing about all these instruments. The instruments bear differing maturities, currencies, risk and structure, and thus may be used to distribute exposure. So now we'll have a quiz. Which of the following statements are correct? Money market is where medium duration debt instruments are traded. It's not about medium, it's like short term. Financial markets can be classified into exchange and over the counter. The answer is yes. A secondary market is where securities are bought and sold by investors. Again, that's true. So 2 and 3 are true. So we can. So the answer is C. The answer is C. So you might have wondered like what is the financial market is like classified into over the counter and exchange. See, exchange is like stock market. So you might have a login, you might have a password, you enter into the system, you trade virtually, and things are over. Over the counter is you you have to like have a broker, okay, or a financial intermediary. You can directly contact a financial intermediary. They will search a buyer or seller for you, and they will connect that person with you. Okay, so that is called as a over the counter. Okay, so in exchange, there are like millions of people as buyers and sellers. In over the counter trade, you are the only buyer there. The seller has to be found by the financial intermediary. So that is called as the over the counter. So before discussing the various types of money market securities, what we'll do is we'll discuss about what is a non-negotiable instrument and a negotiable instrument. So first we look at what is a non-negotiable instrument. Financial instruments that are not be transferable or saleable from the holder to another are non-negotiable instrument. Okay, so for example, I go to a bank, I create a financial deposit. So they give me something called as a financial deposit receipt. That's a paper. Can I sell it to you? The answer is no. I cannot sell a financial deposit receipt to another person because it is a non-negotiable instrument. These can only be redeemed by the owner of the bond. So for example, I cannot sell the instrument because my name is printed on the instrument here. So I am the owner of the instrument, only I can redeem it with the bank. So in the same way, even for a bond, only the person whose name is entered on the bond, he only can redeem it. Non-negotiable instruments are typically illiquid in nature. See, once here I have created a 5-year FD. Okay, only on the 5th year I can get the money from the FD, or I have to break the FD, for which I have to pay a penalty. In simple words, I cannot sell it to another person when I need the money. So non-negotiable instruments are typically illiquid in nature. An example of a non-negotiable instrument, also referred to as non-marketable instrument, would be a government saving bond. Okay, so as the name of a person is printed on it, it cannot be sold to another person. That is called as non-negotiable instrument. So we'll move on to the negotiable instrument. So as you have known, a negotiable instrument is something where you can transfer it from one person to another person. So the person who holds the document, he is the owner of the document, and he is the eligible to get the money from that instrument. So it can be transferred from one person to another. Non-negotiable instruments are always in written form. So it tells how much of money is due, when it is like repayable, and that it is always like the holder is the owner. So the best example is a check, promissory note, and a bill of exchange. To know the best example for a promissory note, our currency is a promissory note. Okay, so the currency is, if you have 100 rupees, you are the owner. If I have that same 100 rupee note, I am the owner. Okay, so that is called as a negotiable instruments. So we'll now look at money market deposits. Money market deposits are very short term loans between banks and banks. Okay, so it is like transferred between banks and banks. The rate at which banks borrow from each other is the London market rate. Okay, so the London market rate sets the rate for the entire money market throughout the world. The London market rate is also called as the LIBOR. So LIBOR is a reference rate through which the banks throughout the global financial system transfers their money. And money market deposits are very short term. So we've already discussed, it can also be a overnight loan. So these are like very short term loans for banking purposes, which are fixed based upon LIBOR. So that's about money market deposits. So we'll move on to the treasury bills. Treasury bills are short term notes issued by government. So the key point in a treasury bill is it is issued by government. T-bills are issued in maturities of 91 days, 180 days, and 364 days. So the maximum is 1 year. The central bank is the one which issues this treasury bills. The T-bills can be purchased through an auction. Okay, there are auctions which are being held and we can buy it online itself. The T-bills are usually issued at discount from par. Okay, we'll see like what is issued at discount from par. So as we have said that these treasury bills are similar to a debt. Okay, but they don't pay debt. The reason is treasury bills are zero coupon securities. They don't pay interest. Now only we've said it's a debit instrument and they will pay interest, but suddenly we also say that they are zero coupon securities, that is they don't pay interest. Then if we deposit our money, what is that we get? So we'll have an example. So there's a 91-day treasury bill which has a face value of 100 and the current price of it is 98.2. So how do you make money from this bond? See, you can sell this bond. Okay, after buying it, you will make a profit. Okay, so you can buy it at 98.2 and you can sell the same bond after 100 days, after 91 days to the government itself at 100. So you will get 1.8. Okay, this 1.8 is the interest. So the interest is not like explicitly given, it is implicitly given. So it is inside the selling price itself. So that's about the treasury bills. So we'll move on to the certificate of deposits. So certificate of deposits are like very simple. It is like depositing your money with a bank. An individual or company lends the bank a certain amount of money for a fixed period of time, and the bank in exchange agrees to repay the money with specified interest at the time period. So it is like nothing but a fixed deposit. They are one of the several types of interest bearing time deposits. So fixed deposit is also called as time deposits. The certificate constitutes the bank's agreement to repay the loan. So you should always have the certificate. Okay, if you lose it, no problem, you can get it from the bank again, but you have to show the proofs. The maturity rates on the certificate of deposit range from 30 to 6 months. So you can deposit your money as a fixed deposit for a minimum of 30 days and a maximum of, I think, even 5 years or even 6 years time is available, but the book indicates it's only like 6 months. So we have another question. Which of the following statements are correct? A certificate of deposit is an example of money market instrument. Yes. Money market deposits are short-term loans between organizations such as banks. Yes. Treasury bills are bought and sold on discount basis. Again, the answer is yes. So all the three are right. We'll check the answer. Answer is D. So we'll move on to the next one. It's called as repos or repurchase agreements. A repo is a short-term borrowing by government for government securities. So when government wants loan, then they will try to borrow money through repos. Government sells securities to investors, usually on an overnight basis, and buys them back the following day at a slightly higher price. So it's like very similar to treasury bills. They are issued at lower price and repurchased at a higher price. For example, again we have the same example. You can buy the security at 95 and you can sell the security at 100. The difference of 5 is the interest. Many corporations arrange for their banks to transfer excess cash to such funds automatically. So the repos are usually bought by companies who have surplus funds. These agreements are most liquid and the time period can even last for 24 hours to several months. So that's about the repos. They are like very similar to the treasury bills. So we'll move on to the commercial paper. Commercial paper is an unsecured short-term promissory note. Okay. So there is no security involved or pledged or collateral is given. So who can issue it? Creditworthy corporations. Commercial papers have a maturity of up to 270 days. Banks may act as an agent in the transaction. They are in no way obligated with the respect of repayment. So banks can act as an intermediary, but they don't take any risk in terms of promising the commercial paper. So we'll have a question. So again, it's a September 2016 paper. Which of the following statements are features of money market instrument? A negotiable security can be sold before maturity. The answer is yes. A negotiable security is transferable, so you can sell it to anyone. The yield on commercial paper is usually lower than that of treasury bills. The answer is no. Why is it no? Because commercial papers are issued by companies, treasury bills are issued by governments. Usually, which one is safe? Treasury bills are safe, commercial papers are risky, right? So what happens is the yield on commercial papers is usually higher. As they have more risk, they are higher. So this one is wrong. Discount instruments trade at less than face value. So we have an example of treasury bills and we also have an example of repos. So this is true. So 1 and 3 are true. So B should be the answer. Let's check. So B is the answer. So we'll move on to the next one. It's called as banker's acceptance. What is a banker's acceptance? A banker's acceptance is an instrument produced by a non-financial corporation but in the name of a bank. It is a document indicating that such and such bank shall pay the face amount of the instrument at some future time. The bank accepts this instrument, in effect acting as a guarantor. Bankers' acceptance are generally used to finance foreign trade, although they also arise when companies purchase goods on credit or to finance inventory. So we'll put it very simply. Assume that you want to buy raw materials, but the supplier is not giving you because he wants money and he doesn't believe in your honesty. So what happens is you as a company, you go to the bank, you ask the bank to give a banker's acceptance note. So he issues you a certificate. With that certificate, you go and you give it to the supplier. The supplier then gives you the raw material. Okay, the supplier gives you the raw material. So how did the supplier who didn't believe you but believed the banker's acceptance certificate? Because the bank acts as a guarantor. That is, if you don't pay, okay, the supplier can go to the bank and ask for the money, and the bank will give that money. So this is like very useful for small companies where the suppliers don't believe them and they have to buy raw material. In that case, this is like very useful. This is like also useful in terms of at the times of exporting and importing. So especially it's like useful at the times of importing. The same manner can work rather than having the supplier. There can be a foreign supplier. Okay, there can be a foreign supplier who doesn't know you. So you can give the banker's acceptance to him and he will give you the goods. Okay, so that's how banker's acceptance work. So we'll move on to something called as a securitization. Securitization is the process of taking an illiquid asset or a group of assets and through financial engineering transforming them into a security. So we'll see an example. Securitization is the financial practice of pooling various types of contractual debt such as residential mortgage, commercial mortgage, auto loans, credit loans, selling debt obligations related cash flows to third party as securities, which may be described as bonds, pass-throughs, collateralized debt obligation. So we'll look at the picture and again we'll come here. So this is a picture. So assume that a bank has a lot of auto loans. Okay, these auto loans will take at least 5 years to get the principal and interest back, but the bank wants immediate cash. So what they can do is assume that they have around some 10,000 auto loans like this. So they can package all this 10,000 auto loans. Each auto loan will take it as 100 rupees is there. So the total worth comes to 10 lakh worth of auto loan. They sell it, they make a bond out of it. So they make a bond out of this auto loans. Okay, so the bond would work like this. They will issue 10 lakh bonds, each worth a face value of rupee 1, and they will sell it. So earlier it will take 5 years for the loan to get repaid and the bank will get the principal and interest, but now the loans are like totally put together as a 10 lakh loan. They are now issued as a bond. Okay, this bond can also called as collateralized debt obligation, and it is sold to investors. It is sold to investors. So now this 10 lakhs will go to the bank. This 10 lakhs will go to the bank and bank is like very happy because they have got their loans. But as an investor, what he will get, whenever that each of these auto loan people, whenever they pay interest plus their principal, both this amount will flow into the investors. Okay, so the bank will nowhere now come in picture. They are gone. The transaction now happens only between the people who have got the loan and the investors who have invested in the bond. Okay, so that's how securitization works. Rather than seeing them as scary, it's better to see them as images. So now you go through this topic, we'll get an idea. Securitization is a process of taking illiquid assets or a group of assets and through financial engineering, transforming them into a security. So that is the bond that we spoke. So it can take any of these types of assets, selling the debt obligations related cash flow, that is the interest plus the capital repayment or the principal, or it's called as the principal, to third party investors as securities, which may be described as bonds. What is being sold to the investor, it can be called as bonds, pass through securities, or collateralized debt obligations. So that's about securitization. So international money and capital markets are available for large corporations wishing to raise large amounts of capital. So if any company feels that it is better to go to another country to raise capital, because for example in India the capital market is smaller in size. So if companies want to raise a large amount of loan, then they usually go in for international markets. So larger companies are able to borrow on euro currency. So we'll speak about what is a euro currency, or they can also go for euro bonds. Okay, so we'll discuss about what is a euro currency and a euro bond. So euro currency is a shorter duration kind of a loan. It can also be a loan or it can also be a deposit, but the logic is it's a 3-month loan or deposit. So what is a euro currency? So any euro deposit, we'll just have an example like this. Whether you're doing a euro deposit or a euro borrowing, okay, whether you do a euro deposit or euro borrowing, it does not indicate the euro at all. Okay, assume that you are an Indian company, and you want to raise dollars, and you want to raise loans in dollar. You want $100 loan, but you don't want to issue this in US, not in US. The question is not in US. So you do this in Japan. So look here, an Indian company wants to raise a loan of $100, okay, but they don't want to do it in US, they do it in Japan. Okay, this is called as euro currency. So a euro currency is the currency which is held by individual or institutions outside the currency of issue. So if you are going to raise US dollar currency in US, then it's not euro currency. Euro currency refers to you are raising a currency, a loan in a particular currency denomination out of that currency country. So you want dollars, but not in US, but in from Japan. So that is what euro currency refers to. When a company borrows in a foreign currency, the loan is known as a euro currency. For example, if a UK company borrows US 50,000 from its bank, the loan will be in euro dollar loan. Okay, so again that's another kind of an example. So the same thing can be applied to a euro bond. The only difference is the time. The time duration is like more than 1 year. It's more than 1 year. Except for that, everything remains the same. So you can also see this as an example. A euro dollar bond is denominated in US dollars, issued in Japan by an Australian company, would be an example of a euro bond. So all the other points remain the same except for the duration of the loan. If it's like euro currency, it's within 1 year. If it's euro bond, means it's more than 1 year. Euro bonds are attractive financing tools because it gives a flexibility for a company to choose which country they want to offer their they want to raise or offer their money. And the main thing is there is no regulatory constraints with this euro currency or euro bonds. So we'll have a quiz. A euro dollar time deposit is priced on deposit basis. So does it have a price? Any time deposit does not have a price and all. So they is wrong. May be issued by a Japanese bank. Yes, it can be maybe issued by a Japanese bank. It is a certificate of deposit denominated in euro. No, that is not the case. So the answer should be B. So you can read the explanation for yourself. Okay. So now we've come to the last part of our discussion. So you can just pause the video and see the rates. Why interest rate differs between different products. If you go for a loan, housing loans have 12%, car loan 16%, personal loan 20%, credit card loan is 35%. Why is the difference between the interest rate? Even this interest rates differ in terms of deposit, even these interest rates differ. Do you know the answer? Why? It's because risk. Okay. The risk level in each type of loan is different. For example, you cannot take your house and run away anywhere. So, and also the ownership of that house is given to the bank. So, the bank has full security. Car, you can take the car and you can go to a different state. You can sell it in parts and you can vanish. So, no one can find it. So, this has a high risk. Personal loan, you get the loan and you run away from the state, very risky. Credit card loan, he just gives you a credit card, you use the total limit and you just walk away, so it's more risky. So the logic is the risk the risk is the determining factor here. So there is a trade-off between risk and return. Higher higher risk borrowers, okay, must pay higher yields on their borrowing to compensate lenders for the greater credit risk involved. Okay, so what is risk? See, the chance that an investment's actual return will be different from expected. So you thought a share will give you bought a share at 100 rupees and you thought it will give you 200 rupees, but suddenly it fell to 50 rupees. So there's a high variability. It means that a high risk. But if you deposit in a fixed deposit, you thought it will give you interest plus capital repayment at 110 rupees. So there is no option at all. You will get this for 100%. So here in case of a fixed deposit, there's no risk, but in terms of a stock, there is a risk. Okay, so that is what he says, a chance that an investment's actual return will be different than expected. You thought 200, it might be 50, but here you thought 110, it is still 110. This includes the probability of losing some or all of the original investment also. Risk is usually calculated through standard deviation, okay, based upon the historical returns or share price or average returns of a investment. So what is a return? Return is the gain or loss that you get from a security for holding it for a particular time period. So it can come in terms of interest, dividend, or the capital appreciation in price. So it can be in percentage. So the logic works like this. If you want a high return, then you have to take high risk. The more risk you take, the greater the potential for high return. So we look at the risk return trade-off. So this is how it works. This side you have the risk, this side you have the return. So if you take low risk, you get low return. If you take high risk, you get a high return. Okay, so that's how they are linked. So this is how various classes of assets instruments are like segregated. So there are like few things which are like very riskless, and there are like things which are like very risky in nature. So you can go through this diagram on your own. So in specimen 2016, they have asked this question. So this question asks you about the different levels of risk and return for a particular capital instrument. So this is the only question that has been asked over a period. So it mostly comes in 2 marks, but in In more than a theory, it won't be like asked in section C part of the question. So thank you very much for watching this video. We'll meet in the next video.